The US is just hours away from imposing a new round of tariffs on goods imported from China, with the Trump administration refusing to defer the plan. China has called off trade talks with the US officials. How do these escalating tensions impact emerging markets like India? Let's ask veteran emerging market equity strategist Adrian Mowat. He joins us from Hong Kong. Adrian, good morning. Thanks so much for joining in. Really appreciate you taking the time out. Now, this is a known devil. In all probability, $200 billion worth of tariffs kicking in, 12 a.m. Washington time, so in about 3 hours from now, our time. Do you think the markets are already prepared for that? Or could this throw open a fresh round of volatility for emerging markets?
I think you used a very good expression, this is a known devil. The markets in Asia and also US stocks that are impacted by trade wars have been hit since July. We have had this announcement coming through, and markets, if anything, have moved up a little bit. So I think we're probably coming to the end of the impact of trade wars on equity markets, insofar as there's been a fair amount of discounting of the tariffs. I think it's also important to sort of highlight that the tariffs don't seem to be impacting the electronics sector as much as people had feared. And in terms of market cap, that is very important in Asia, particularly in Korea and in Taiwan.
Interesting. So are you saying, Adrian, that if these, I mean, let's work with the presumption that these tariffs kick in, there are no negotiations from either of the sides, and at some point of time, China would retaliate in some shape or form as well, this will not have a meaningful impact? I've heard various figures about people saying that even when these tariffs kick in and there is an impact on the US markets too, as a percentage of GDP, it's a negligible impact, and therefore the equity markets may be making too much of it, but maybe it will not be as drastic an impact. Are you on that side as well?
Well, I think firstly, there's a lot of different things to sort of reflect on with what you just asked. I would highlight that the world economy is moving more towards free trade than against free trade. Now, why do I make that statement? If you look at the European community, it signed free trade agreements with Japan. It's signed free trade agreements with Mexico and Canada, as well as Australasia. Within Asia, yes, the United States has left the Trans-Pacific Partnership, but other Asian countries are moving ahead with that. And so if we look at this on a trade or GDP-weighted basis, we're actually moving more towards free trade. Now, there are specific industries and companies that are impacted by these tariffs. And I think the share price movements since July have been reflecting that. So I would put sort of two ideas forward here. One is that the market has quite clinically analyzed the situation, and it has been reflected in stocks that are more impacted. Secondly, I think we might be overemphasizing the trade dispute on a global context. If you look at what's been happening with negotiations with Europe, including through to sign deals. The other thing I'd also like to highlight that economies tend to be much more about domestic consumption and investment. That is also true of China. I mean, one mistake we made back in the 1970s and 80s was we overemphasized the importance of trade for the Japanese economy rather than the importance of the domestic economy. The signals that we're getting out of China is that despite a considerable slowdown, actually a contraction in shadow banking finance, despite a strong focus on the environment and reducing energy use, the Chinese economy continues to track at quite a healthy pace. So long answer, but I think the markets have already discounted the story.
Adrian, the other question is the whole conversation for the last 12 to 18 months around how the global growth and the global GDP is moving up because of, well, one, coordinated policy action, yes, but two, trade across the world stepping up, and therefore the GDP print on a lot of large economies has been looking reasonably okay than what it was in the preceding 3 years. Does that get threatened at all, or would you reckon that one, the GDP numbers will look okay, and therefore the markets will take those as your stride as well, if this were to escalate further?
Yes, so look, I think there are negative implications of this trade war. And you have seen quite a lot of economists shaving a few basis points of growth rates, including in places like China. There will be some impact on business sentiment as they are uncertain to go ahead with investment decisions because of these tariffs. It may, in some countries, generate some benefit if it's deemed that investing out with China is a better course of action. But I think at the margin it'll have some negative effect, but it'll be much more marginal. And I think the normal domestic cyclical cycles will probably be more important.
Okay, Adrian, my final question really is on India. Now, we had some domestic factors as well which have impacted our markets. What's your sense of how does India shape up in a scenario like this? Trade wars, Fed taper, rate hikes, and steep valuations, but the micro looking strong.
Yes, so I think we acknowledge that the macro is looking reasonably strong in India. We have an equity market in India that an index level has performed extremely well relative to other emerging markets. Although when we drill down to the details of that, one could argue that it's been a slightly more defensive and export-orientated bias to the outperformance. I think the cyclical dynamic to look for in India as we go into 2019 is how much do inflationary pressures build? The Indian consumer is extremely cost conscious. It tends to take a bit of time before you can pass through increased costs. And with the rupee where it is, combined with the oil price, there clearly are higher costs. And you can see that in some of the damage that's being done to the profitability of industries like airlines. So next year, I think the cyclical story for India is really going to be all around inflation and RBI policy. And I think that is probably a more challenging environment than we've seen in 2018. Now, with regards to the Fed's raising rates, ultimately this is a sign of good news in that the US economy is strong, unemployment rate is low, and you're getting a normalization of monetary policy. That said, it is generating a strong dollar, and it's generating a strong dollar against a backdrop of some very specific emerging market stress. So we would highlight South Africa moving into recession, the stress we're seeing around Turkey, not an emerging market, a frontier market, but a place like Argentina does tend to dominate the headlines. We've also got political issues to consider in places like Brazil. And I think when you get the combination of the Fed raising rates, plus these specific EM issues, the asset class is very much out of favor. And what happens with India is that India suffers from some of the redemption selling that you see in passive products. And the rupee also suffers in that environment, in that India still runs, albeit a modest current account deficit. It is a current account deficit. So I think India definitely fits in with that. Trade wars, I would to some extent say that India is relatively isolated from trade wars. So far, Trump's trade rhetoric has been very much focused on goods as opposed to services, which would impact the Indian IT space. So I think you dominate your discussions and your strategy in thinking about the domestic cyclical for India next year. Okay. And then the other factors probably tell you a little bit more about timing and why you might continue to see some pressure in terms of FII selling.
Interesting, but a lot more sanguine, Adrian Mowat, than what I would have presumed. Adrian, good having you. Thank you so much for taking the time out and joining us and giving us your perspective.